Thank you, James. With an introduction like that, I can hardly wait to hear what I have to say. Okay, it's late. Everyone is getting tired, but let's keep it going. Great job, Andrew. For a complicated topic, I think Andrew did a great job of making sense of it, and that's what I'm going to try to do for everyone here. So, for the lawyers in the room, for the people in the room that are wondering about all the numbers I'm going to put on the screen, there's not that many. This is a forward-looking statement. It is an exempt market product, which means that they're risky, there's liquidity. People need to read the paperwork. They need to understand the risk before they make any investments. So I encourage people to read the fine details. Oh, okay. Good. You didn't see that legal disclaimer. I know I'm going to trip over the cord, maybe. Just kidding. James says, don't do that. So just to give you, Christina Crossan is my business partner. Christina came out with me. She is my right hand, my left hand, and my brain often. She's young, and I'm bringing her into the world of real estate. I've sold real estate for the past 30 years. I bought a lot of real estate in Alberta. I made a lot of money in Edmonton. And I'm hoping in the future that we're going to see Kenny win the battle when it comes to getting some pipelines built for Alberta. I love this market. It's been tremendous for us. So, again, forward-looking statements. Read what you're buying. This is our track record. We have transacted almost $100 million over the last 5 years since I formed Investment Revenue Realty with my partner, Taylor Steele. Christina's been working with us for the last 3 years. And we also have an investment real estate brokerage. So just so people understand what the relationship is between us and the people that we're representing, we are in the exempt market space. We are like the brokerage is to the realtors, to the clients. So we act as agents for our clients. So our duty is to our clients trying to help them understand what they're buying and to vet the investments that we're recommending to them. So this is the real estate side that we have. We represent developers, mostly in British Columbia. That's our home. But we work with investors by raising money, assembling land, and doing brand new build on investment condos, townhomes, homes, and duplexes. So we've been doing this I've been doing it a long time. My team is fairly young. I'm going to build a legacy for them because it's built me a tremendous amount of wealth investing in real estate. So now where I'm really focusing my energy is in the private equity space. So what is private equity? Private equity is private companies that you're investing in. And how you'll do, I'm going to explain a little bit about the structures. Andrew did a tremendous job talking about the technical side of it. What we've seen over the past decade is a tremendous increase in money flowing into private equity. And this is why we're seeing more products and more companies that have come into Canada Pension Plan. They have gone from very, very little in real estate private equity to almost 50% of our pension plan is invested in real estate. So obviously I call this smart money. The people that run these financial institutions are people that spend a lot of time analyzing. So real estate's been a great provider for building wealth. In last year, RBC teamed up with BC's largest pension fund, and they raised $7 billion. It literally took them 3 days to sell out $7 billion. So this is the appetite for real estate. Why is this happening? Fewer companies are going public. So in doing that, these companies are raising money through the private equity space. And this has typically been restricted to larger institutions. And what we are doing in our space is we're bringing it down to the retail investor. That's you and I that have smaller amounts of money that want to put our money to better use in higher returning equities. So this is at the highest point now since the inception of private equity. We're seeing a tremendous amount of money flow into this. So it's all about pairing talent with equity. And as I said, usually this has been reserved for institutions with large amounts of money. And now what we're seeing is this is coming to us as retail investors. So what do you want to look for? And I think Andrew touched on it. You really want to understand what are the characteristics. High quality management. And in today's world of, analyzing and having access to internet and being able to look at these companies and these people, it's not that difficult to do your own homework. They have recurring revenues, strong recurring revenues. And you'll see just by the fact that the company is growing, their revenues are organically increasing every year. So these are the types of companies, for example, companies that acquire more businesses and build those and take those businesses over, consolidation in any industry. That's going to build more organic revenues for them. And then low capital. So in terms of our looking, when we're looking for companies, we want companies that have good leverage. They're not over-leveraged. Their debt, their financing's in place so they can operate even in cyclical ups and downs in the market. And then the ability for that money to flow through to our investors. That's really important. So, and then as they grow, their margins grow bigger exponentially. And I'm going to touch on a few of these. But right now, I think if I look at the marketplace, what are the things that are the big high-level themes that are going to change and be industry disruptors, I call them? Technological innovation, artificial intelligence, demographics, shifting demographics. You're seeing in emerging economies, middle classes growing rapidly. These are things that are going to change the types of companies that are growing and the types of companies are going to be going to these markets. You want to look and be involved with them because these are the shifts that are happening. And climate change, environmental, ESG. So one of the things that we are looking for in assessing companies is leadership. What is their investment process? And how do they manage risk? Because it is a more risky investment, so we want to make sure we have the best in terms of this type of investment. Here's an example of a company that I've raised, I think, close to $90 million for with my team. They've acquired, now it's 73 properties, just over 16,000 doors, about $2.2 billion in transactions. They've placed over about $600 million. And to date, they've sold 31 properties. And this is the multifamily value add in the U.S. It's buying C buildings, repositioning them to B-plus buildings, and they've divested. And they've returned on average 30% annualized gross return to their investors. So it's been a phenomenal story. It's a young company. It's 5 years old. Emerging trends nationwide. This is a company that is building vertical storage and car washes in combination. So they find high location or high traffic locations, and they buy the land that's cheap because it's generally bordering on highways, so it doesn't make a lot of sense for residential. It doesn't make a lot of sense for anything else, but it's great for the businesses that they put on them. So this company's on its fourth fund, and they've had very solid returns to date. They're just going to start seeing some of their investors paid out from their first fund. They're IROC management, so that is just a very high level of corporate governance, as well as they have audited statements every year. So I think Andrew touched on when you're looking at how do you know if a company's telling you the truth? An audited statement by a large accounting firm is generally a pretty good start. Also, they have great reporting, so every quarter they're reporting to their clients what's happening. You're always kept in touch, and they're extremely transparent. So we love this. Self-storage. In big cities like Vancouver, like Toronto, Edmonton, condos aren't getting bigger, they're getting smaller. This self-storage now, they can put it just about in any pocket of land, and because they're doing vertical and they're renting by the cubic volume foot, the returns are much, much better. It's not the old self-storage that you think about where you had the chain link fence and the big dog running around to guard it. These are surveillance, fob entry, computerized, skylockers where you can put your seasonal skis, golf clubs. These are things that are really innovative and starting to really hit the market, and these guys have got a great business model. So we formed a fund, a mutual fund trust. We looked to the types of businesses that are recession resistant, and they offered superior risk-adjusted returns. So the top are manufactured homes, self-storage, apartment, and student housing. So this fund will focus on these sectors. So when we talk about diversification, we're going to do both geographical diversification as well as asset class diversification in different cities. Some of the companies that we're putting into these are, again, we focus on companies that have been in business at least 5 years, have a proven track record, solid management, and aren't startups, so that we're not worried that they can't execute on the plan that they've set out. This is the student housing company. It's called GEC, so it's a global education city. They have 5 locations. They have over 4,500 student beds now under management, and they have a super city in Richmond and Burnaby. And so they're an amazing company that's really Canada's #1 when it comes to international students. Vancouver, we see a lot of it, so this company is predominantly in the Lower Mainland right now, but they will be expanding across Canada. There's also the structured investments. A lot of people are looking for the security. Now, these have typically only been sold at the institutional level. This is a new company that we were introduced. The management has been with RBC Private Equity. The people that are running this company have just started it up because they're doing it with large institutions. So it's not a new concept. It's a principal protected note, which means your investment's completely backed by a Schedule I bank, so you won't have risk on your capital. And this is a 10-year investment. So it doesn't apply to everyone, but it certainly is a really neat or unique, innovative way to invest with your RSPs and do catch-up. It operates on a 50% upfront payment, and you earn appreciation on 100% of the investment. So they've made a structure that allows you to kind of put an ETF on steroids. Again, we look for innovation, we look for tax strategies, we look for ways for our clients to keep more money in their pocket. So why is this happening now? It's institutions have basically been the angel funds, venture capital funds. These have all been big money, $250,000 maximum. So people have been not able to do it, but they have been phenomenal returns to these investors. So as a retail investor, I look for ways to not put all of my money in these types of assets, but certainly it can boost the returns that I'm getting by expanding into the exempt market space. So what I talk to my clients about, my goal in doing all this is to sit down with my clients and ask them, figure out what your success story is. What is your financial success story? What are you expecting, and what do you want to do? What are your goals and objectives? I know this sounds basic, but so many people take a look at their position today and say, I just need to get here tomorrow. They don't factor in how they're going to get there, and I really encourage people to look and understand the risk and the return and make it suitable. Make it suitable for your particular situation, and look for cash flow. Look for cash flow characteristics. So when we talk about suitable in the private equity space, they say that no more than 5 to 10% of your net financial assets should be in any one issuer. So if you have $1 million, you shouldn't be putting more than 10%, which would be $100,000, into any one private company. Probably $50,000 if you're at $1 million. That's a suitable investment for you to make. You shouldn't be putting more than 30% of your net financial assets. When I say net financial assets, I mean your liquid cash, whether that's stocks, bonds, cash, RSPs, anything that you can liquidate. That's called net financial assets. So you should be looking at that as your suitability factor when you make these investments. Accredited, I know Andrew touched on it. These are the most common ways that they measure accredited investors. So it's either $1 million net financial assets, or you have household income of $200,000 for an individual, or $300,000 for a household, or $5 million net worth, which would be include your real estate and your net financial assets less any liabilities. And then there's eligible investors. So this is a BC presentation. I'm sorry I didn't put the Alberta slide. It's slightly different, but eligible just means you aren't accredited, and there's certain restrictions to doing it. One of the things that I talk to my clients about is, diversification. If you want to get diversification, you're better to put into a mutual fund trust that has the diversification built into it, because the cost to invest in these investments, there's a cost to it. So the less you put in, these fees start to eat into your return. And then there's the non-eligible. Again, there's some restrictions to how much money you can put in each year. And that's done under the securities legislation, and that would be the Alberta Securities Commission. They regulate what we can recommend to our clients. So let's talk a little bit about structure. So the Western Wealth Capital is a limited partnership structure. So this is it's like a sophisticated joint venture agreement. There's the general partner, which is Western Wealth Capital, and they look after all of the investment. They have all the veto power over how the money's spent, where the money's spent, when it's paid out. That's what they do. You, as the investor, are the limited partners. You provide the equity into it. So you have no say. You basically are looking to how am I going to make money and understand the business plan and this investment structure. The beauty of these investment structures, I'm not going to go into all of this because I think Andrew did a very good job of explaining them, but mostly on these investment structures, the benefit of it is there's tax efficiency. So you've got mortgage investment corporation, mutual fund trusts, limited partnerships, real estate investment trusts, and then you have the structured product. So there's a whole variety of them. I would say with the mutual fund trust, there is independent trustees that have ICD designations, and they're independent of the management of the trust. Therefore, they have veto power over any decisions. So it's a little bit more governance than, say, a limited partnership. They don't have to have independent trustees, so they can basically do what they want without any oversight. So that's, understanding that, your money's protected by a third, fourth, fifth set of eyes. If you're getting audited statements versus notice to readers or a review engagement, again, just understanding those terms to know that when you read something, the depth of it and what it means to you. The tax efficiency is really all about the cash flow through. I think I talked about that. You want to make sure that you can have the money flow through to you most tax efficient. And that's how these structures have been designed. Some of the considerations that I look to my clients to do their homework is the management experience. I can't stress that enough. If they've done their business for 5 years and they've been very successful and they have good track record, the chances of them continuing is pretty good, unless they're in a highly volatile industry. So you have to know what you're investing in. Fees. Fees can chew away a lot at your return. So understand, and they should be clearly outlined, and any kind of pro forma or projection should say, this is net of all fees. It shouldn't say, if it doesn't say net of all fees, I would discourage that because you don't know where the fees are or they're trying to hide them. Liquidity, redemption. A lot of these investments you can't liquidate. There are restrictions. There's, a scale. Year one, it's 5%. And it scales down, but you want to understand what you're going to pay if you have to liquidate. Risk. I think this is the most important one that I can't stress enough. If you don't understand the risk of the investment, probably you shouldn't invest. And you should be getting, how can I lose all my money? Tell me how I can lose all my money. I want to understand that, and I want my clients to understand that. Transparency. So do they provide all their financial forecasts? Can they show me everything easily and clearly? How do they keep reporting to me every month, every quarter? Are they providing me the information I need to keep up on the investment that I have? And then how am I sharing in the revenue? Are they getting paid fees before I'm getting paid? Are they getting a profit share before I'm getting paid? Or do I get a preferred return? And all of this, again, should be clearly outlined on a summary sheet so that you can look at it to make the first decision before you have to read a big, long document. Because once you start reading the offering memorandums and all the legalese, it soon gets muddied. So part of our job is to simplify understanding the document and have reference when your questions come up to be able to point out to a specific part of that document to explain it to you. And then taxation. So capital gains are taxed better in Canada than income. So you want to understand, how am I going to get taxed when I get that profit? When am I going to get that profit? Is it, again, how am I going to keep as much money in my pocket as I can? It's kind of a repeat. Diversification. So not only asset class, but geographical diversification is really important. I mean, if you have a lot of properties in Alberta, you might want to think to go outside of Alberta just to diversify your holdings. If you have a lot of assets in single-family homes, you might want to look to a different asset in the real estate space if you like real estate. I love real estate. That's how I made all my money. I'm not a big fan of the stock market, but that's my bias. I think people have to make their own decision. That's part of your financial success story. What do you feel most comfortable, and what do you know best? And again, everyone's different. Professional management, what oversight is there? What governance is there? So for me, I look to the management of the companies that we're investing in, but I also look to the people that are assessing the investment, the independent scrutiny of those investments, those pro formas. What are the criteria, and how do they assess it? Also, lastly, just in terms of governance, independent trustee is a great governance tool, and I encourage people to look at that. Income and profit distribution. A lot of the investments that we have and we offer, it's very aligned to our investors getting their money out first before there's any participation by the developers or the issuers. So what's next? We do a lot of educational events, just like this. This is an event that we host in Vancouver probably every quarter, and we bring out guest speakers from BDO to talk about U.S. tax considerations for the clients that are considering Western Wealth Capital. We bring in mortgage brokers to talk about, the Smith maneuver, how to set up your HELOC, how to save more money, how to put money in your pocket first. So we do these on either a newsletter, we'll put it out, we'll do a big event, we'll do a webinar, we'll do smaller events. We have all sorts of educational events. And the one thing that I've really come to learn through doing this for 30 years is that if you don't have a financial plan written down with some clear milestones, it's no different than not having a business plan. So it's just so critical to get really clear. My financial story is I grew up on the prairies in Saskatchewan on a farm. Can't believe that, a long time ago. I know what cold weather is. And, my parents were hard workers, but they had no financial plan. They lived, okay, we'll go on holidays. No, we can't. I hated that. As a child, I hated it. So I decided that my kids were all going to get a car, a house, and an education. That was my financial story. It wasn't about I was going to retire in Mexico or retire in Hawaii. That's not my financial story. I had a passion about being different than my parents, and I built that financial story, and it has proven, I wrote it down, I believed it, and I went after it. And I did not deviate. And I encourage everyone to get that clear, because then you will succeed. If you don't have that clarity, you're going to start chasing some shiny objects, and you're going to run off, whether it's buying in Edmonton and having 10 of them with suites in them and having 5 paid off in 10 years. I don't care what the story is. Just write it down, have your partner understand and agree with you, and set up a plan to succeed. Because where I see failures happen is people come to events time and time again, and they get all excited. They go home, their partner's not with them, and nothing happens, and I call them, and they go, well, I just can't do it. So they keep coming back hoping. So I encourage people to have that hard conversation, because the only way you're going to do it is by jumping off the ledge. I went and borrowed money against my home to the chagrin of my husband and bought 10 properties within the span of 10 years. And he just looked at me and went, are you crazy? What are you doing? But it worked. It has worked. And so it does work, but it's not easy. Ask for a proposal. Get the proposal in writing. Ask the questions. The dumbest question is the one that isn't asked. I know these are all cliches, but it's right. If you don't ask the questions, you're not ever going to get the answers. Ask the questions, the hard questions. I tell my clients, if I give you a proposal and I send you links to documents and you don't come back with 10 questions, it's unlikely I want you as my client, because you haven't read anything. So you're going to have selective memory when it doesn't work out. There is risks to these things. I want you to understand your risk. And match your outcomes. If you need cash flow, it's important then buy investments that give you cash flow. Don't buy investments because someone says, oh yeah, but if you buy this now, it's going to be worth this much more in 5 years. Look to what you can expect. Scale it back. I know we get criticized because our pro formas don't look great. And I say I run my pro formas based on actuals. I don't care. If I like the property and I believe in the fundamentals and this is the pro forma, I know I can live with my pro formas. I've done this far too long to say I'm going to put a pro forma down to sell a property. It's not worth it. That's not sustainable. It's not sustainable for you, and it's not sustainable for me. This is my favorite one. If you don't understand it, don't invest in it. The writing and the material that you get, not the shiny brochures. We have shiny brochures, but we have lots of documentation, lots of research that goes behind it. The fact of the matter is a lot of people will invest in stuff because they were kind of sold, they were told they should do something. No one loves your money more than you do. No one. So think about it, make decisions, get a plan, understand it, and invest systematically. Just keep doing it. You have to open an investment account with us. It's not a big deal, but they're going to ask you all these questions. My goal is to set up a platform where my clients' behavior is going to be tracked. I believe in technology. I'm not sure if this will work, and I don't know if the sound will work, it will work? Okay. So what we've done is we've created a platform that we are going to build in a lot of artificial intelligence so that my clients can go in and look at things, and you're going to see that this is going to work for you and build your performance based on your behaviors and what you want.
To reach customers wherever they are, serve them at their own pace and in their own time. Over the past 4 months, Triview Capital has undergone a digital transformation. Today, we are proud to introduce Triview Capital's new digital investment platform, a world-class software built to provide a better customer experience for our investors, issuers, and dealer reps. The Triview Investor app, available on web and mobile, allows you to manage all your investments in one seamless experience. We've eliminated the paper processes to create a better customer onboarding experience. This saves time, eliminates errors, and provides a secure way for you to share your personal information and identity documents with Triview Capital. Our digital deal room has everything you need to make an informed investment decision. Available 24/7 on any of your digital devices. A powerful tool for issuers to tell their story, provide full due diligence, and allow you to execute on investment transactions. We've streamlined the subscription document process.
I'm not sure if you can hear that. So we've invested the money because we believe that this is going to help people. I've invested this money in terms of making it a difference to my clients, helping them make better informed decisions. And I think if we can do that, we are going to take advantage of the next big thing. And there's a lot of wealth in the world today. We're looking at the things that are happening right now, the Netflixing. When you watch a movie on Netflix, all of a sudden it tells you 3 others you should watch. So this is going to track your behavior in the investment world. It's going to bring things to you that you might not think of or do, but it also is going to factor your objectives, your age, your net worth, your financial snapshot. It's going to allow you to make better decisions quicker and easier. And then it's going to help you hit those goals. It's going to say, you need to be here, like step, step, step. I didn't do my 300 steps today. Well, I didn't make those 2 things I needed to do. So ultimately, our goal is to educate, help people make informed decisions, and make sure that you're on track. And, this is 2018. It's happening. And as advisors, we have to recognize the power of AI. Watson, IBM. Why did they develop Watson? It makes better medical diagnosis for clients or for patients, and it helps people survive longer. So these things, I embrace technology. I think it will help us all make better decisions, and I want to be a leader in it. And that's it.